Hello, and thank you for joining us at Competitors or Collaborators, the future of CBDCs and cryptocurrency. We'd like to give a special thank you to our sponsor partner, Celo, for helping us bring this event to life. We want to hear from you during this event. Please be sure to submit questions via Slido to our speakers. To access Slido, you can click on the Join the Conversation button located at the bottom right-hand corner, or access it using your mobile device by either scanning the QR code on screen or going to slido.com and putting in #ForbesCelo. Now, please join me in welcoming Richard D. Parsons, Board of Directors, Celo, Senior Advisor, Providence Equity Partners, LLC.
Hello, everyone. I'm Dick Parsons, and it is my pleasure to welcome all of you to today's discussion of the future of central bank digital currencies, or CBDCs as they're commonly referred to, and cryptocurrencies. And what a great time to be having this conversation. Things are happening out in the broader world that are going to have an impact on all of us as we go forward. And the question that's always present when you're in the midst of change is, do you get in front of it and shape it, or do you run behind it and react to it? And fundamentally, that's what we're going to be discussing today. Let me share a perspective from someone who lived in an industry for a while that's been transformed by technology. I refer now to the media industry. I think you heard earlier that I was chairman and CEO of Time Warner back in the day when it was the largest media company in the world. And, we looked out on the horizon and we all saw the digital wave forming, but we had no idea of how impactful and transformative it was going to be to our industry, or how quickly it would arrive. And as a consequence, today that industry looks markedly different than it did 15 years ago. The competitors are new and different. The largest competitors are not the legacy content businesses. In fact, Time Warner, as you know, doesn't even exist anymore. And the way in which, and this is the most significant part, the way in which consumers both make and get access to content has been totally transformed. It's different. And I see that same phenomenon happening in the financial services space. The financial services business that I knew is going to be transformed in a more profound and impactful way, I think, than even the media industry was transformed. And the question for all of us is, do we get in front of it and help shape it? Do we collaborate to create a system, an integrated system that's better and more inclusive than what we have today? Or do we get run over by it and end up with something that is uncoordinated and does not really move the ball forward in terms of providing services to people around the globe? So that's why I think this is an important conversation that we're starting today, and why I'm speaking to you at this moment. I think it couldn't be more important, and it couldn't be more timely. Now, let me say a word about one of our sponsors, Celo. As you heard, I'm a member of the Celo Foundation, and I joined the foundation because I wanted to be a part of helping shape the future and being a part of the new insurgents crowd, I'll call it. For those of you who haven't heard of Celo or don't know about it, it's a mobile-first digital platform that enables people, anyone with a smartphone, to get access to the tools and services that are available in the financial services sector. Now you say, all right, mobile first, what does that mean? That means it's available to 6 billion people around the world. That's how many mobile phones are out there. And 6 billion people is more than the total number of people in the world who have access to running water, to put this thing in perspective. So, and Celo doesn't do it by itself. Celo's created a platform, and we work with a number of partners currently. Past and present partners include the World Bank, the Grameen Foundation, the Mercy Corps. The list goes on and on. There's a bunch of folks who have collaborated with us, putting a currency into the hands of people that enables them to access the system at much less cost, and it's much more inclusive. So the Celo technicians who will be here, I think, today to help facilitate this discussion, not only have a dog in the hunt, they have the right perspective on collaborating and enhancing the system as opposed to competing with the system. So I want to thank Forbes also, because they're a sponsor of this. I want to thank some of these speakers that we've lined up who are just terrific, a terrific group of individuals to help us think about the issues and discuss the issues. And of course, we want to thank all of you who tuned in and are participating in today's discussion. So with that, I'm going to turn it over to the next speaker so that we can get into the substance of this PDQ right away. Thank you all. Bye-bye.
Now for our opening conversation, please welcome Jay Ramaswamy, Chief Risk and Compliance Officer, CLabs, and interviewer Michael Del Castillo, Associate Editor, Forbes.
Good morning, good afternoon, good evening, wherever you happen to be joining us. One of my favorite parts about working in the blockchain and cryptocurrency space is it's a truly global endeavor, which means our audience is frequently coming from all over the world. It's a pleasure to have you here with us, Jay. Looking forward to having the opportunity to pick your brain in front of untold millions. You've had a pretty wild career working with the federal government, working with Bank of America. You've frequently been sort of on the prosecutorial side, looking at how people are using technology to hide their identities. And now you find yourself in the private sector helping reimagine the very nature of money. Hopefully for people like me, you know, with an eye to protecting people's privacy. So thank you again so much for joining us. I wish we could spend an hour talking about your career, but just for the sake of kind of giving our audience a chance to get to know you a bit, if you could go back to an early point in your career and tell us a little bit about something called Liberty Reserve. What's its relationship to what we now call cryptocurrency, and what was your involvement in the Liberty Reserve bookmark in crypto history?
Sure, happy to, and thank you for having me here. It's a pleasure to speak to you and to the entire audience here. So sure, I'm gonna go into the Wayback Machine and go back several years ago, which seems like an eternity, I think, in crypto years or in internet years. But to start off with, what was Liberty Reserve? Liberty Reserve was what I would call the first generation of digital asset providers that emerged in the 2000s as the internet was sort of coming into maturity, as Web 2.0 was coming into maturity. And what they tried to do was essentially to create a, similar to the banking system, a private ledger system that would be able to move money both within borders and outside of borders. I think because of their architecture, the view of the government at the time was that these were traditional money service businesses, that what they were doing was no different than other money service businesses and or hawalas or others that were regulated movers of value. And Liberty Reserve itself was located in Costa Rica, and there were people who used it to move value for legitimate reasons, but a huge amount of the value they transferred was involved in child pornography and human trafficking. It was involved in pin caching, which I know that's going to date me, but was an earlier form of money laundering and extracting value out of the banking system through ATMs en masse. They were involved in carding, and yet another way of extracting value through cybercrime. And so there was a lot high yield investment schemes, so investment fraud. And They were located in Costa Rica, and I think took the position that the U.S. didn't have jurisdiction over Costa Rica. But U.S. jurisdiction tends to be pretty broad. I always tell people, even today, that you may think that you don't that the federal government doesn't have jurisdiction, but because the dollar is lingua franca economically across the world, you'd be surprised where the U.S. has jurisdiction. So Liberty Reserve.
Roughly what years are we talking here? And I'm sure you learned so much from that experience that is being implemented today with your work at C Labs and elsewhere. But could you just, first of all, again, roughly what year, just to give our audience an idea of exactly how long you've been around, and then just pick one thing that is like really, really important that you learned from that experience that you're using today.
Sure. So the prosecution itself was in 2013, and I don't have the exact dates, but the conduct spanned a few years, several years before that.
Okay.
And the one thing that I learned from this is that it's really important as a prosecutor. And at the time, I was the chief of the asset forfeiture money laundering section, at the Department of Justice. So we were in charge of, among other things, prosecutions of all financial institutions, including some major banks, of violations of the Patriot Act and the Bank Secrecy Act. But the thing I learned was it's really important to understand the mechanics of what's going on in these newer digital payment systems before you can even understand what the implications are from a compliance or from an enforcement perspective, because the technology itself is changing the way we are imagining the financial system. And those are really early iterations that in many ways mimicked many things. But I think we saw with the rise of the Bitcoin white paper that something new kind of emerged. And it was really important to dig in and understand what was going on here or be left behind.
We've had a chance to talk in the past about some of the sort of pivotal moments on the way to what we now call central bank digital currency, or CBDCs. You just mentioned one of those pivotal moments, which was Liberty Reserve itself, and another one, the Bitcoin white paper. But I want to kind of come forward a little bit and go to another pivotal moment. Other than Liberty Reserve and the Bitcoin white paper, what's the biggest pivotal moment that you think everybody in the audience needs to be aware of as far as how the future of central bank digital currencies is going to look?
Paradoxically, because I'm in a different project, I think that it was probably the events around Libra and the publication of Libra white paper, which I think accelerated much of the conversation that we're having today. And what I mean by that is, I think even in the government, when I was there, and then when I went to the private sector, the blockchain technology, cryptocurrencies were still seen as relatively niche. There were some criminal prosecutions of Silk Road and others, and so people saw it as a new mode of criminal behavior, illicit finance. But there was also, buying a pizza with Bitcoin, and so there was lots of stuff happening there. But I still think it was seen as niche, and I think what the Libra white paper caused people to realize is that this is a technology which is still embryonic, but if it went to scale and were married with the sort of technology platforms that are out there that actually work at scale and that bring networking effects effectively into their business model, you could have a real challenger to the payment systems we have today, and potentially even fiat currencies and sovereign currencies. And I think that was a pivotal moment, and it happened to coincide almost within a short time span with what the Chinese government was doing with their own digital infrastructure and the digital one. So I think I kind of cheated here, but I think it was probably two pivotal moments kind of mashed into one that got people really thinking in this space. And then there's a bunch of other things, but I think in my head, those were two kind of significant moments.
So I want to unpack that a little bit. So you mentioned that the Libra white paper forced central banks around the world and others to sort of reimagine what might happen at scale. Whereas previously it was kind of one-offs here and there, relatively small offerings. This was something that could be implemented to billions of people overnight. But what specifically got people thinking? Or maybe to be a little more on the negative side, what specifically got people scared?
I mean, look, I wasn't in the halls of government at that time, but from my perspective, seeing the reaction, I tend to think it was two things. One was the illicit finance potential, and that was clearly front and center, and it was identified as a potential risk. And we can go into the pros and cons and whether that's as big a risk as people assumed it was. I think there are pros and cons on both sides. And then the second issue was, I think, the kind of monetary sovereignty issue, what this would do to the banking system. And because in large parts of the world, the banking system is what's used to transmit monetary policy and economic power in some senses, I think it was that. And if you ask me, it was probably that second. Probably the audience will have a better sense than I will of what actually drove the conversation. But my sense is it was those two principal concerns that started really animating the discussion.
And so how does one strike that balance between protecting privacy and enabling massive illicit activity? I don't know if you want to take that from a technical perspective, or if you want to take that from a prosecutorial perspective, a legal perspective. I don't know. Like, if you could pick one or two things, like, how do you strike that balance?
Look, I think that the whole panoply of laws that have developed around the world, and I've written an article on this earlier last year, that the whole panoply of laws that has arisen has always tried to strike a balance between illicit finance and privacy goals. And it's done so in a way by, you can't disclose SARS or suspicious activity that's reported in financial institutions under penalty of criminal prosecution, I might add. On the other hand, you're required, people are required to disclose to their financial institutions who they are. But much of this has arisen in the context of what I would call default privacy, that information is kept in siloed servers and siloed ledgers at banks across the globe. I think one of the things that's transformative about the public ledger, but also in a sense scary from a private privacy perspective, is that you've got public ledgers that are now transparent, that I think help in money laundering. And we've seen many instances of that happening over the past several years, including most recently Colonial Pipeline, that help combat illicit finance. But on the other side, the traditional KYC principles that really focus on financial intermediaries are very difficult to apply in what's increasing, potentially a peer-to-peer world. And so I think that's where the tension is. How much transparency are we willing to accommodate, in a sense, in the financial system to combat illicit finance? And I think there's going to be a balance there struck in this new technology, just as it was struck elsewhere, but it'll be a slightly different balance. And there may be technological solutions, like, and I'm going to throw out some lingo here, but zero knowledge proofs and other cryptographic solutions that may allow us to square the circle here in a very novel way. But it's going to require regulators to think also novelly in the same way that engineers are thinking, in new ways around this technology. But I tend to be an optimist, and I think that there are solutions both regulatorily and technologically to make a better mousetrap here.
So we've heard a lot of talk about some of the risks around a world of CBDCs. And of course, for every risk on one side is an opportunity on the other. So just to rattle off a couple here in the interest of time, negative interest rates as a way, programming negative interest rates into currency to ensure that the economy is moving. Maybe restricting certain kinds of expenditures on government subsidies, that sort of a thing, which I think both you could see positives and negatives for each. And for every person that's terrified of one of those being implemented is someone else who's very excited about it. You've had a chance to work with a lot of central banks over the years, and I think probably more than ever since joining CLabs. What's the one thing that has got central banks most interested about the idea of creating a smart layer on top of traditional currency?
It's hard to say if there's one thing, but I'll just rattle off a couple of things to again, cheating a little bit. One of them, I think, is is real-time payments. Our system is very archaic in the way it's architected, and I think some countries have moved forward more quickly than others. But the possibility of real-time payments and real-time settlement, I think, is something that that interests people. Low cost, potentially. And then I think some of the things that you mentioned around the transmission of economic policy, and there have been colleagues of mine at Celo, I think some who are on panel, some coming up, who have mentioned this. And so I think it's a whole host of issues, but that's where design becomes really important as you're thinking about CBDCs. Really figuring out what kind of a design you want and what are the pros and cons of the different types of architectures which are possible becomes really important.
Wonderful. And how many central banks would you estimate, or you may know as a fact, are taking the possibility of a CBDC seriously?
Look, we've had conversations with dozens. I can't get into specifics or give you numbers, but dozens of central banks, and we're in a conversation with a variety of partners who are seriously interested in exploring this technology from a CBDC perspective. And so I think it's widespread interest in what we're doing.
Would you go so far as to say all of them?
Well, I can report what the BIS has reported, that I think it's 80% of central banks are considering things in this space, and that may have grown since that report. But at last check, I think it was around 80% of central banks.
And the business reporter in me notes that you said one of the possible benefits is low cost. For every dollar somebody saves, something else has to be cut out. There's possible middlemen to be removed from this equation here. Is there one person that you would benefit, one group, one organization who has the most to lose in a world enabled by central bank digital currencies?
Look, I think the traditional banks obviously have quite a bit to lose. Some by other fintech companies getting into this space, and other types of competitors that are enabled by this technology. But clearly, the banking infrastructure is in a period of change and massive change, and I think will face greater competition. And I don't think that's a bad thing.
Jay, thank you so much. It's a great note to end on. As you indicated earlier, our upcoming panels will have an opportunity to go into much more detail on the overview that you provided. Thank you so much for joining us, and looking forward to hearing from our next speakers.
Thank you.
As we move into our next session, Shaping the Future of Digital Currencies, please join me in welcoming panelists Ezekiel Kopik, former Treasury Liaison, Federal Bank Reserve of New York, Head of Public Sector Research and Development, C-Labs. Fiona Van Eckelpol, Deputy Director General, Directorate General Market Infrastructure and Payments, ECB. Benedicte Nolans, Head Innovation Hub, Hong Kong Center, Bank of International Settlements. Marcelo Prates, Lawyer, Central Bank of Brazil. And moderator Vipin Barathan, founder DLT.NYC and contributor Forbes.
Thank you for that introduction. And we have a wonderful panel assembled here who are both in the central bank space, as well as they have either experience or worked in other areas. That's a wonderful thing. So I'm going to just start asking questions. The first one is for everybody, because I want to talk about why we are here. The first question is, were there no cryptocurrencies and stable coins, could we be here discussing CBDCs? That's the first question. If there were no cryptocurrencies and stablecoins, would we be discussing CBDCs? Probably start with Fiona.
To be here, Vipin. It's a nice question, and I think, of course, digital currencies were being discussed before crypto assets and stable coins started to gain ground. But I think probably what was a kind of a watershed moment was the announcement by Facebook back in 2019 that it was going to launch a stable coin, because this was a point in time where there was something coming that maybe address some of the challenges that were there with crypto assets like Bitcoin, at least on the volatility side. Even if we still have some doubts about the stability of global stablecoins, still it gave a sense that here was something that could be a credible challenge to traditional payments methods. This is something that was provided or going to be provided by a big tech firm that has a very extensive and global user base. It also raised concerns, I would say, with respect to sovereignty too for many jurisdictions. So I think this is something that accelerated the thinking on the part of central banks, also authorities, finance ministries as well. They became more interested in the topic of central bank digital currencies. I would say it's even broader than that, even cross-border payments more generally. We've seen in the last year or so the G20 come with an extensive roadmap to address the challenges in cross-border payments, which was one of the points that the initial Facebook initiative wanted to tackle as well. So I think it was a coming together definitely of these things that helped move us along maybe a little bit quicker than we would have done otherwise.
Who should go next? Should be, let's say, Marcelo.
Thank you, Vipin. It's a pleasure to be here with these fantastic panelists. Well, since we are in this event about collaboration or competition, I'd say that the current monetary landscape leans toward collaboration rather than competition at this time, because the main types of digital currency out there end up offering these complementary options. For retail payments at the national level, the digital forms of sovereign money that we already have, from bank deposits to credit cards, they don't have a strong competitor. If not for other reasons, practicality plays in favor of sovereign money here. If you are in the US and all prices are denominated in US dollars, it's costly, if not impossible, to use your pounds and euros when making everyday payments. So that's why it's so hard for a monetary competitor to enter the retail payment space. And that's why this space is where I believe a CBDC can be relevant. For cross-border payments, things change a bit, because sovereign currencies, even if put on a blockchain, they lose much of their appeal. With almost 200 sovereign currencies subject to different rules and regulations, sending money from one country to another is usually time-consuming and expensive. And the main problem here is not the lack of technology, but the lack of political coordination. It's hard to bring hundreds of countries to the same table and ask them to reach a consensus on anything, much less on money. For these reasons, I believe that Bitcoin appears as a strong option for international payments. As Bitcoin is unbacked, has no issuer, and is not linked to any jurisdiction, one Bitcoin in a Japanese wallet can be transferred to an American wallet or then to a Brazilian wallet in no time and with relatively low cost. So no CBDC or stablecoin can beat that, at least for now. But finally, since we are talking about these different options, if you're unhappy with Bitcoin's environmental costs, or if the strong emotions that may come from Bitcoin volatility are not for you, but you still want to face some risks in search of higher returns, you have all the stable coins now. So these American cousins of the more traditional and more regulated e-money that exists in many jurisdictions can be used in the DeFi world, which is kind of this financial system running in a parallel universe. So what could change this balance of complementary monetary options that seem to exist today? My guess is that a private digital currency issued by a big bank or a big corporation or a big tech and adopted globally for retail payments would break this frail stability we now have. Imagine Bitcoin, but issued by a private party with a global presence and a network of billions of people. So the degree of monetary competition would then be higher than ever, and we could even see some kind of money wars.
Very comprehensive answer. Is there anything more to be said about the matter by Benedict Nolans, maybe?
Yeah, so maybe I remember the question. So I will give quite a simple and straightforward answer, and again, my views may be my own views, right? But I definitely think that particularly Bitcoin acted as a catalyst, and after Bitcoin, really the Ethereum and then all the different ICOs that happened. I think without these catalysts, the change that we're at now would not be so rapid. And I also think, in fact, that Libra or now Diem was in fact in many ways an offshoot of what had already happened with Tether and USDC. So I think it's all one sequel.
It's all related, in other words.
Yeah. So my answer is, I think without crypto, we would not be talking so much CBDC. We would still have gotten there because the economies are turning digital and you need digital money. But I don't think we would have gotten there, or we wouldn't have gotten to the prominence of, let's say, 80% of jurisdictions considering this topic had we not seen that speed of development. And I would say that speed of development is really not that old. It's dating back to around 2015, because while Bitcoin is older, the whole of the ICO boom and therefore the boom of cryptocurrencies was really only starting 2015.
With Ethereum. Anyway, Ezekiel, any further thoughts?
Yeah, I mean, I certainly agree. First of all, thanks for inviting me. I mean, this is an honor to be on the panel with such esteemed guests. I would agree. I mean, I think we would have eventually gotten there, but I think that the form certainly would have been different. I mean, obviously, a lot of our money is digital now. So talking about a central bank digital currency, I mean, you could see us getting there, but it might be more of a wholesale type of variety that we've kind of already been talking about. I do think that, what Marcelo was saying and others about, Bitcoin certainly providing that impetus for a decentralized idea, right? This distributed ledger. Central banks are by their very name centralized. So I don't know that we would have necessarily gotten to a decentralized version. And you wouldn't necessarily then have had this proliferation of financial inclusion focused technology. And so I think the form would certainly be very different. And again, as Benedict mentioned, the speed as well by which we've gotten there would certainly probably be a lot slower. And so, eventually we'll get there, but it's good to see that we have the innovation now. And I'm excited for where we're going.
So the next section, I had meant to ask each one of you different questions so that we can cover some ground rather than, going over the same ground again and again. So this question is back to Fiona. There is an argument that currency is already digitized, which Ezekiel just mentioned, because commercial bank money is digitized. And that is 80% of all money created in this world. And it is also quite decentralized, strange as it may seem, that the commercial bank money is the creation of that money is decentralized. Another is that stable coins fulfill the payment function, as argued by Governor Waller, for example, similar to private currencies and narrow banking. So again, back to the question, which is if all of these uh, rails are already present, why do we need CBDCs? I mean, it's the same question in a slightly different form.
Yeah. And a very interesting topic, Vipin, and one I think that has occupied the minds of central banks also in the last 12 or 18 months, because indeed, you're absolutely right that there are options out there. But what we felt, at least speaking for the European Central Bank, which has launched now an investigation phase for a digital euro for the next 2 years, and what we felt is that we need a sovereign option when it comes to a digital option to cash. And it's not our intention to replace cash. We haven't absolutely decided either if we would issue a central bank digital currency. This is something that will only come at the end of the investigative phase that we start now. But from our perspective, and speaking for the central banks of the Eurosystem, it was felt important that we should also have a place in the digital space, in the digital economy, to make a central bank offering there.
Which points to the idea that it's a multi-pronged approach, meaning there will always exist multiple payment rails, multiple ways of looking at things. So coming back to the design, which the gentleman before was talking about, design of CBDCs or design of any of these currencies, there is the token versus account debate about all currencies. This debate is usually based on the ideal token-based currency, which is basically cash. I mean, it's a total bearer instrument, anonymous, peer-to-peer, private, but the main problem with it, of course, is that it's physical. So if you cannot show up at the pizza shop, you cannot buy pizza directly with cash. So this sort of debate about token versus account is a non-issue as far as technologists are concerned, actually, strangely enough, because they feel that this is a distraction. But is this also a shorthand for other debates? The token versus account debate is a shorthand. And since you, Ezekiel, said that before, I would expect you to answer this question.
Sure. Yeah. Thanks. I have to admit that my answer actually comes from one of Benedict's colleagues, Raphael Auer, who recently gave a talk, and we were discussing this idea of token versus account. And as you had mentioned, for technologists and for people kind of really focused on this, it really isn't that much of an issue. And instead, he kind of viewed it, and I think correctly so, that it's kind of more of a shorthand for this idea of anonymity. So, we obviously equate CBDCs and with sort of the digital version of cash, right? And with cash, you can certainly have full anonymity, right? Because you have this piece of paper, or I guess linen, right? Or plastic, depending on where you're at. And so there is this amount of this anonymity that you have. And then with the digital versions of that, you may not have full anonymity. There may be varying scales of it. I haven't seen yet a tokenized version of it. Everything sort of already has an account implicitly built in, since you sort of have this public and private key. And so I think this idea of token versus account is probably more on varying shades of anonymity, right? Do you need full anonymity? Do you need pseudo anonymity? Do you need sort of maybe like full transparency? And so I think that's probably where the so the argument and the conversation debate should really be had. I think that account versus token can sometimes get confusing. So I'd like to see us go there, and I'm certainly very thankful for all the work that the BIS and other central banks have done on sort of kind of fleshing that out.
Well, you know that Kenneth Rogoff has written a book called "The Curse of Cash," which is presenting the opposite picture, which is cash allows bad actors to slip under the radar and do things that are not supposed to be done. Anyway, so we can talk about this for a bit, but I think I'm going to go to the question that I had asked Benedict, which is about compliance and cross-border. You have multiple projects in the BIS Innovation Hub, MCBDC, Project Dunbar, Nexus. They're all based on different technologies and different ideas. I haven't even mentioned the latest one with the, that is MCBDC, I suppose. So please let me know what you think of having these multi-pronged approach. I mean, that seems to be what we're coming back to, that there are going to be multiple approaches.
Yeah, I think, to be frank, it's more than likely that there will be multiple approaches. But I think towards connecting it to just the prior point, I think the key point is that ultimately for approaches to survive, they must be compliant in some way, right? We can't be in a world where we have another big terrorist act simply because we didn't want to put in place AML or because we thought it was too difficult to do it. So all the work we're doing in the BIS is actually respectful of the need to have very strong FCC controls, FCC as in financial crime compliance. So, for example, the Enbridge builds in having a tiered system where the banks continue actually playing the exact AML role that they've played in the past. The retail CBDCs that we're working on, again, they might be both actually might be tokenized towards the prior question. Both might be tokenized, but they will be able to only function in KYC ecosystems. So whether that is a KYC platform system, as for a multiple CBDC bridge, or whether that is in the context of a wallet for retail CBDC. So I think the key question really that I think remains, or the key challenge that remains outstanding for the crypto sector is to really nail the AML issue. Because as long as the crypto sector cannot actually properly take care or properly ensure that AML is taken care of, I think there will be really a question around whether it can mainstream and whether it's long-term sustainable. So it definitely can exist, but for it to mainstream, it needs to start acknowledging that this FCC topic is actually critical. And I think we just, passed 9/11, it's not long ago. We have to keep in mind that is a consequence of not having proper AML controls. An accident like that, or not an accident, an organized crime, could happen again. So I think it's very important again. So I think everything can coexist on the long term, as long as it is compliant. And to be compliant, I think in this context of specifically crypto, the key point is going to be around, as I said, nailing the FCC issue or the AML issue.
Thank you for that. The compliance issue, on the one hand, everybody wants, to achieve market adoption, you needed compliance. That's what you just said, or to be widespread. The people who are in certain areas like DeFi or Bitcoin, they debate whether that is a feature or a bug, meaning it is actually what it's meant to do is to be censorship resistant, not be compliant. So what further can you say about that, Benedict?
Well, again, I have a very simple answer to that, right? I think none of us, whether we believe in censorship resistance or not, none of us want to see A, a repeat of 9/11, and B, none of us are, I assume, supporters of crime, right? Like murder, slavery, and all of that. So there are some things that we as humans share, and I think what we share is that we want to live in a society where you don't have material crime like that. And so FCC systems, financial crime compliance systems, are actually there to help prevent that. Now, we all know that in the past they haven't fully prevented that, but it's quite different to say, let's not even try to prevent it, right? Or let's create a system that can't prevent it. That's actually quite dangerous. So I think, again, we need to go back to common humanity on this. This is not about, let's say censorship resistance or privacy protection. This is around protection of our common livelihood and society. So I think it's really important. And I think it's quite critical that, as at all parties start getting that message. So for CBDC, for sure, we're focused on AML. It's not a question, it will need to be in place. Equivalently, so if the crypto sector really wants to compete with state-backed money, then it must find a way to get to compliance. If it wants to mainstream, it needs to get to compliance. If, of course, it doesn't want to mainstream and it wants to be in the side flow, so to say, the side rivers from the main river, that can go on very long in uncompliant fashion. But I think from my time actually in this industry, and I was in this industry for reference, I think that there are people who have the right AML mindset. And as was said in the prior panel, I do think eventually maybe we'll get there. But I think the priority needs to be raised for sure.
Thank you. The next question is, we have seen a whole host of such irreconcilable differences, privacy versus KYC AML. Then we have financial inclusion versus speed, all these different ways in which these irreconcilable differences show up. So Marcelo, how do we reconcile these so-called irreconcilable differences? Is there a way out of this?
Well, it may be, because if we look for the options that central banks have to design a central bank digital currency, they could use a blockchain that could provide some kind of not full anonymity, but at least a high degree of pseudonymity, so that the real identity of the persons transferring digital money would not be revealed, at least to the operator of the system or to the nodes of the system. But I guess at this point, for central banks to use the blockchain technology, they are not, I think they don't have this, they are not sure that the blockchain technology would provide the number of transactions per second, the bandwidth required for implementing a CBDC, which is basically a form of digital money for retail payments. And the requirements for this type of digital money are a little different. We're not talking about wholesale anymore. We're talking about retail. Another option would be for central banks to learn one thing or two from the open banking initiatives, and instead of trying to create this killer app for digital money or find this killer system for digital money, to develop what is called the APIs, the application programming interfaces that can link different systems. So, and with that, maybe central banks would have a chance to integrate different systems and try to face these challenges and these different challenges that central banks have right now.
Beautiful, thank you. So I have been asked to ask Ezekiel to make an announcement, which is very important announcement for his organization.
Sure. Yeah, and I think sort of in conjunction with how central banks, how the public and the private sector can work together. One of the things we've been working on at Celo is trying to make sure that we can work with central banks and help sort of answer some of their questions about some of these design options that Marcelo and others have talked about. And so one of the things that we're announcing today is an initiative called Provo, which is a free sandbox for central banks to help them build and design and to kind of just test and experiment with various different architectural options on the Celo platform. So we're, basically helps them in sort of a simple, cost-effective way to learn and understand, because I think right now we're all in this education phase, right? We're all in this learning and experiment phase. And so we just wanted to provide a space for central banks and international institutions to just kind of think about varying different aspects, right? So whether that's interoperability or privacy or thinking about different system architectures. We're in varying stages right now with some institutions, and we'll roll out more information as we go along. But we just wanted to sort of let people know that was out there, and certainly happy to discuss it offline at any point after time. So thank you.
No problem. Sorry about that little segue into a separate area, but I think we are going to come back to this whole notion. Well, Marcelo talked about the killer app. According to me, anyway, the killer app is going to be the wallets. That was what I had written in Forbes Crypto and over a period of time. So the main thing about the wallets that I want to ask Fiona is that will that be controlled by the central bank, or will that be under a standard that central banks will bring about so that you satisfy some of Benedict's concerns without surveilling and tracking everything? And since where the interaction takes place is the wallet itself, it would be much more timely, meaning that a payment system or a monetary policy implementation will probably happen at the wallet level. So do you have any thoughts to share on that, Fiona?
Well, let's say when it comes to our own thinking on our digital euro, we are not that far advanced yet. It's definitely something that we have to look in. As Ezekiel said and others have said before, that the design aspect is going to be crucial here. And coming back to what you said previously, Vipin, on the how did you put it? The questions that where we cannot reconcile the answers to different questions. What I see here is that we will have to strike a balance, and there will have to be choices that have to be made. And there are definitely issues to be looked at, even from a central banking perspective. We don't want to, even for central bank digital currencies, we don't want to challenge financial stability. We don't want to challenge monetary policy implementation. We have to find a design that avoids a run on banks. What we have been thinking about ourselves for our own digital euro is to limit the amount that individuals would hold to try to manage some of these aspects. So there is a lot to be looked at in the next couple of years when it comes to the design, and the design will be crucial for answering some of the critical questions that are being posed at the moment.
Well, although most people say that we are still in the learning phase, some people have hurtled ahead. Let me put it that way. people like the smaller countries in the Caribbean. Now, of course, one of the biggest economies in the world, China, is poised to do this, and they are doing something similar to what you suggested, which is some kind of tiered wallets, which below certain amounts and below certain total transfer amount per period, like a month, you do a wallet that can only hold a certain amount, and then so there's a whole series of various tiers in the wallets, and it seems like it's not very clear whether the Chinese have created a standard for these wallets that have to be followed by the commercial banks. So that brings us back to the idea of a two-tier system or a single-tier system, which is obviously also another debate that is going on. So, Benedict, could you opine on that? And after that, we go to audience questions for about a minute or two.
Yes, sir. I would say for the two projects we have in the Hong Kong Center, so one for which we actually issued a progress report today called Enbridge, so it can be viewed on my LinkedIn profile. So for that system, it's clearly a two-tier system, so the banks are fully in the system. Other participants can actually be in the system as well, although at current it is the banks. Secondly, we have also a project on retail CBDC, and watch out for some more information on that this week as well. But as we have disclosed on the website, that is also a two-tier system. So it has either PSPs or banks in the CBDC system. So in both cases, really two tiers. I do think if I look at around the world, I haven't seen many central banks who are doing single or one tier. In some, I haven't seen real appetite from central banks to be managing the accounts of millions of individuals. So my own, if I needed to make a guess, it's going to be two-tier. China is two-tier as well. And as you indicated, the wallets have very different levels. And there is, let's say, certain levels of anonymity for the very small payments, but the higher the payments get, the less anonymity there is, or the more identity verification is required, which actually is very similar to the current system, right? Because we have to keep in mind that even in the current financial system, there are de minimis exceptions. It's very important to keep that in mind. They're normally $10,000 and less. And there's quite some consistency globally around these numbers. Now, in China, the levels are lower because in emerging markets, 10,000 is quite a lot. But in the international FATF context, oftentimes you hear reference to the 10,000 de minimis.
Thank you all for showing up and participating in this session. I think a lot of people are very anxious about the whole CBDC concept and, of course, stablecoins and cryptocurrencies. Thanks to all of you.
Now for our next fireside chat conversation, the role of commercial banks for CBDCs. Please welcome Chris Giancarlo, former CFTC chairman, and interviewer Stephen Ehrlich, Forbes Digital Assets Director of Research.
Hi, good morning, good afternoon, good evening to everybody, depending on where you are in the world. I hope you've enjoyed this event so far. It's been really illuminating from my point of view, and obviously it's a very important topic. We have a terrific guest for you right now, Chris Giancarlo, who, as you just heard, is the former chair of the CFTC, and as probably a lot of people in the audience know, he's also referred to as crypto dad in the community for a lot of the work he did to sort of further the advancement of crypto derivatives while he was in that important role. And Chris, welcome. And I'd like to really just start there. I mean, when did you first hear the word crypto dad? And I know we've talked about this in the past. You have children, you've raised a family. What does that term mean to you as it pertains to CBDCs and digital assets?
Yeah, thanks, Steve, and it's great to be with Forbes today in this great program. I got that title in the most unlikely of places, and that was a Senate Banking Committee hearing in February of 2018. A few months before, my commission, the CFTC, had green-lighted the first crypto derivatives. In that case, it was Bitcoin futures. And the Senate Banking Committee called a hearing to talk about Bitcoin. And I prepared for that hearing, fully expecting to be lambasted for, in the words of some senators, legitimizing Bitcoin. And so in advance of the hearing, I prepared a 45-page submission to the committee, explaining what we had done and justifying the decisions we had made. And I fully expected that hearing to be fairly aggressive. And as I was preparing for it the night before and looking at this 45-page submission, I thought, you know what, let me just approach this differently. And so the next morning I said, Senators, if you don't mind, I'd like to talk to you for a moment, not as the chairman of a federal regulatory agency, but as a father of children and nieces and nephews, all of whom have, quite frankly, not a lot of interest in Wall Street and finance, but are absolutely fascinated by this new innovation, which is bringing a whole new generation into financial services and financial inclusion. And I said to that committee, I said, I think we owe it to this new generation to respect their enthusiasm with a thoughtful response to the rise of crypto, not a dismissive one. And then I went on to say that it really was for Congress to think about this with new eyes and a new approach, and in a way that's just not disdainful, but in a sense smart and thoughtful. And my Twitter feed just blew up after that, 50,000 followers, and the crypto dad meme began at that point. And quite frankly, at first I didn't know what to make of it, but I decided it's actually a great way to communicate. And it's actually the title of my upcoming book, Crypto Dad and the Fight for the Future of Money. And it talks about why there really is a generation gap in place today, almost as big as the one that existed in the 1960s and 70s. That was over social issues like the war in Vietnam and civil rights. This one actually is over the role of a new generation in a digital society, and a concern that an older generation that currently runs the financial system doesn't quite fully understand the power of this innovation, what it means for a new generation of citizens in a free society.
And yes, we're going to get into that in a second. But for those of you listening, you may also not realize that there is a crypto mom, SEC Commissioner Hester Peirce. Although if you ever go try to look for wedding videos or photos, they probably won't exist. In your book, one of the sentences that you wrote, which I found really interesting, was the idea that you said money is too important to be left to central bankers. That is a pretty explosive statement in some ways. So I'd love to hear what you meant by that.
Thank you. Well, it's not entirely original. It actually picks up on a statement that French Premier Georges Clemenceau said, or said to have said after World War I, where he said, war is too important to be left to the generals. Well, in a similar way, I truly believe that money is as much a social construct as it is a government construct. In fact, without social acceptance, money actually has no value. Because as we know, fiat money has no intrinsic value. Its value is only in what people believe it is. So society is what gives money its value in any type of fiat system. And thoughtful people, much more thoughtful than me, like Mark Carney at the Bank of England and others, have said as much. They say central banks are the custodian of society's expression of value into their currency. So central banks don't by themselves give money power. It is society, and it's the social acceptance. And so what I meant by that is to say, as we explore a digital future of money, society's got as much of a role to play as do central banks. And in fact, society has been exploring the future of money for the last decade. Central banks are coming to this rather late in the game. And in some cases, they're adopting what I might call a fight or flight moment, whether to expropriate what society's already developed or to partner with them. And last point I want to make on this, in the United States, whenever we've done something big technologically, whether it was landing a man on the moon or building the internet, it was always a partnership between the private sector and the public sector. And I think the exploration of the future of money should just as much be a partnership between the private sector and the public sector. And that's both in the government's interest and society's interest if we're going to get it right, if that digital money is going to have social acceptance and social support.
Sure. Thanks for that. And as you know, I mean, central banks are not a homogenous group. I mean, we're both American. The U.S. central bank, I mean, it's responsible for U.S. monetary policy, but by extension of the U.S. dollar's role as the world's reserve currency, it has external effects. There's many other middle-income countries, smaller countries that have where their central banks have perhaps less independence and less authority to implement monetary policy. So, I mean, central banks are a key player in anything that's going to happen here. So, how do you see? How should central bankers approach this new internet of value, as you called it, based on sort of like their standing in the world right now?
Yeah. So every central bank has unique challenges and unique opportunities based upon the underlying national economy that they service. And as you say, the dollar has some very unique characteristics, very important strengths in the global economy, plays very important roles, not just domestically in the United States, but around the world. And I think the Federal Reserve, as it approaches the notion of a digital dollar, has to take all those characteristics in mind and proceed cautiously. I also say in my book, something as complex and as important to the global economy as the US dollar, any evolution of it into a digital format needs to be done thoughtfully, carefully. And I compliment Chairman Powell for saying this isn't something that the United States should be first at. That's absolutely right. The important thing for any economy is not to be first, it's to get it right. And that's his view as well. I think there's others at the US Fed that have been equally thoughtful about this. I think Governor Lael Brainerd has said that she can't even wrap her mind around the notion that we wouldn't advance the dollar into a digital future as other countries are looking at the same thing. So I think that there's a range of views at the Federal Reserve. There's a range of views in Congress. There's a range of views in the administration. And that's what you have in a free society, in a democracy. You often have a range of views. And that's not troubling in its own right. That will be resolved over time. What's important, though, is that directionally, the official sector in the United States recognize this is happening. Over 90% of the world's central banks are looking at this. 3/5 of them are actively experimenting with this. The future of money is digital. There's no question about that. And it's very important that the major economies, recognizing that fact, begin active experimentation, working with the private sector to make sure that whatever evolves serves society well.
So clearly the United States won't be first. The EU also wants to get it right, not necessarily be first. But let's briefly touch on who is going to be first. China, in particular, with its digital yuan. I mean, I know the Bahamas, I believe, launched the sand dollar. A few other smaller countries have gone live, but China will be the first major economy to launch a digital currency. What are the ramifications for that based on your experience?
So I actually think it is underestimating the potential of what China is building to see it only as a digital yuan, an ECNY as they refer to it. I think that appreciates what they're building. What China is doing is viewing digital currency as basically an operating system for a completely networked blockchain-based financial system. So let me just break that down for a second. You know, the first wave of the internet gave us network information, right? People can go from this presentation today without leaving their keyboard to find articles perhaps that I've written or find things that you've written, Stephen, and from there link to a YouTube video, and from there perhaps engage in a financial transaction. But once they leave the realm of information and go into the financial infrastructure of the Western democracies, suddenly it's no longer networked. You want to trade a share of Microsoft, you go to a broker, you go in the New York Stock Exchange. But if you want to put a hedge on an oil contract, you've got to actually leave that environment, find a futures commission broker, do that. If you want to do a payment transaction or a loan transaction, you're completely outside of a digital network. What China is building is a completely networked financial infrastructure with the digital yuan as sort of the MS-DOS operating system. That is an incredibly powerful idea. And we at the West, with our legacy analog-based financial systems, are a little bit reluctant to embrace that, the power of that idea, but we need to. We can't let a legacy analog infrastructure hold us back from the notion of a completely networked financial infrastructure. And that's what a digital currency can provide.
So I understand the powerful infrastructure that sort of underpins the digital currency. I mean, just staying on China for a second, obviously they're trying to internationalize it. They're building into their Belt and Road initiatives in Central Asia, Southeast Asia, so on and so forth. But there is reticence in the area about accepting China as sort of the new hegemon, and whether or not the yuan will displace the dollar. And obviously with the US leaving Afghanistan too, we're sort of refocusing on Asia as well. I mean, Barack Obama started it with his pivot, I guess, back when he was president. So lots of potential, but what do you think the chances are that this actually gets adopted?
The digital yuan, I think it will be adopted. I think that client states to the Belt and Road Initiative will absolutely adopt this. I think this will provide the digital yuan with a regional and international element that hasn't been there before. You know, money, technological advantages of one form of money have often in history giving certain currencies superiority over others. Think about Chinese paper money during the Tang Dynasty, or the Spanish dollar during the exploration of North and South America, because of its technological superiority being minted with a better silver that was more consistently pure and fractionable into pieces of 8. Technology often gives one currency, but ultimately, I believe currencies compete on a global scale all the time, and the ace card for the democracies will come down to economic privacy. If the digital euro and the digital dollar take the right steps to protect people's economic privacy and shield them from censorship of legal transactions, then those currencies will have an advantage over the currencies of an autocracy in which surveillance will be built into the system from the start. And so in my book, I advocate that what the United States needs to do is not worry about being first, but make sure that traditional democratic norms, and in the United States, our own Fourth Amendment, which protects our citizens from unlawful government invasion of privacy, are built, encoded into a digital currency. If we get privacy right, if we get censorship resistance right, I think the digital currency of democracies will have a tremendous advantage over those of non-democracies.
I think we have time for maybe one more question, and it's an important one. This topic, we want to talk about the role of commercial banks, retail banks, fintechs in this sort of CBDC world. There's a lot of people listening here today that wonder, if there's going to be a CBDC, what role do we have to play? So if you're an executive at a fintech or a bank, I mean, what are the discussions they should be having? How should they be strategizing? And sort of how could all this fit into their businesses profitably moving forward?
Thanks, Steve. I'm glad you made sure we covered that before ending. You know, at the end of the last panel, one of the speakers from the Bank for International Settlements talked about how a digital euro is designed to preserve the two-tier banking system. Well, we very much believe that a digital dollar also needs to preserve the two-tier banking system. Banks in the United States, especially our regional and small and local banks are the fundamental support for the real economy. And we need to make sure that nothing in a digital currency undermines that fractional banking activity they do. And that's why at the Digital Dollar Project, we advocate that digital money would be distributed through the two-tier banking system in the same way that fiat money is distributed today, so that banks can continue to take deposits and use us as the basis for the critical role in lending to the real economy that they play today.
Okay. Well, Chris, thanks so much. I wish I had another hour to ask you more questions, but unfortunately, we're out of the time. Thank you, everybody, for joining us, and please enjoy the rest of the conference.
As we move into our next conversation, propelling CBDCs from idea to reality, please welcome Francisco Rivadeneira, Director, CBDC and FinTech Policy and Research, Bank of Canada; Hervé Thorpe, Chief Digital Advisor, IMF; Rolf Wintergeist, Chairman of the Management Board and Group CEO, Gizyka and Dieberend, Katerina Zubska, Acting Head, Innovations Projects Office and Project Manager, eHarivnia, National Bank of Ukraine, and moderator Diana Barrero-Zales, Director of ESG and Impact, Emergence at Wield & Co. and Senior Contributor, Forbes.
Well, thank you so much for having us. We're so excited to be on this panel on propelling CBDCs and the implementation of this really interesting innovation. We're going to have a discussion on important topics for the implementation of this innovation, and then work towards specific examples. So let's get started with Hervé. Welcome.
Thank you very much, Diana.
So I know that you are at the IMF, and the IMF has partnered with the World Bank to propel the CBDC lab. Can you tell us a little bit more about that working group and your progress so far?
Yeah, exactly. So about a few months ago, about March this year, together with our colleagues at the World Bank, we realized how emerging market and developing economies were being advised by many technology providers. It wasn't clear that they were being provided the best possible advice, the most unbiased advice. And as the IMF and World Bank staff were asked by the same countries to come over and advise them on CBDC, we realized even the IMF and World Bank staff may not be equipped with the most recent knowledge on technology. So we created that lab for internal knowledge development on CBDC. It was quite interesting how we managed actually to rapidly build this technology expertise that now the IMF and World Bank staff exposes to especially emerging market and developing economies. So the first goal was to provide an unbiased technology expertise. And as we were experimenting with those technologies internally, we started realizing, well, there are some technologies that just don't work, others that do work, others that are being unexplored so far that may be relevant to the conversations. And so we work with many companies, technology provider, Consensus, R3, Celo, to really understand how those technology can support CBDC program. And also we're helping those companies to understand what central banks are trying to do. So that helps the companies such as Celo to really understand the policy questions that arise. For example, the question of interoperability for cross-border, with existing domestic payment, with maybe the crypto world. Questions such as offline access, especially in low-income countries where the digital infrastructure may not be supportive of a CBDC. The question of privacy and confidentiality. We even looked at smart contracts within that lab and tried to experiment how, for example, the Ministry of Finance or Treasury would be able to wrap a CBDC for special assistance program, for example, which was very important during the COVID-19 crisis. So we're really trying to make that a reality for countries and really trying to understand the reality of the technology, what works and what doesn't work.
Exactly, because there's a big educational component, especially when it involves that many stakeholders and the stakes are so high. And when we talk about interoperability, it's really important when you mention the interoperability with domestic payment systems, as well as interoperability across CBDC platforms. How and why is that key to the work that you are doing?
Yeah, it's central, especially at the IMF, where we were looking at the macro questions, not so much about the domestic questions, but how that works across countries and how that affects the macro financial questions. First of all, a quick definition of interoperability. Yes, there is the technology questions of interoperability, such as standards, and this is where my team and with the World Bank are focusing. But of course, there is also the question of regulatory framework interoperability or security models and governance. You don't want the security models or governance of one CBDC to weaken the whatever payment system they interact with, for example. So there are big questions around interoperability. But what we're finding is that so far, central banks were simply exploring the possibility of having a CBDC, the impact, the risks and the benefits. And then they realized that they had other domestic payment project going on. Most countries are, for example, revisiting their RTGS system that is a bit dating now, and they're looking at emerging technology to improve their RTGS systems. Many countries are initiating fast payment system on the retail side. And now the question is, and if you add to that the DeFi world, the cryptocurrency questions, the question is, how are those questions converging, in fact? And maybe interoperability becomes an important question, because you certainly don't want to design a CBDC that would not interoperate with your fast payment systems. Those are difficult questions because it's very hard across the silo to agree on standards, on regulatory framework, and on putting resources together. So I think this is the current challenge that CBDCs are facing, and we're seeing a lot of questions around that.
And that's key ultimately for actual user adoption and scalability. And my next question to you would be, what would actually propel that level of user adoption? And what are the risks of a lack of user adoption?
Yeah, to me personally, I think user adoption is really the questions that is the least explored at this point. In fact, let's face it, right? Central banks, they are not in the business of understanding the concept of digital user adoption. They're not the Silicon Valley. They haven't before developed any of those applications that are facing the users. The user adoption has three components, right? There is the value for the users. Users will only use a CBDC if they see a value. So yes, the central bank, but also their partner, the fintech providers, the commercial banks, that's where they have to work to make sure that there is value for the users. The second component is trust. Users will not use the CBDC if they do not trust the CBDC. And of course, the central banks have a major role to play to establish trust. And the last one is ease of use. And that's with technology experts. I like to say that ask the questions, what would Steve Jobs do if he had to develop a CBDC, right? It's a very specific mindset that Apple and other Silicon Valley companies digital experience. And I think this is a piece that is missing today in the conversation.
Right. And finally, from your work with CBDCs so far, and the patterns that you have observed, what are the key priorities and key challenges to get right in order to implement these innovations in the right way?
Oh, that's an excellent question, because on the top of my mind, I'm worried a lot about the question of cybersecurity. Everywhere we go in most central banks, there is a concern about IT environment and cybersecurity. Forget about CBDC. I'm just talking about the existing IT environment and the governance around cybersecurity. So the way we tend to advise that until you've got your cybersecurity governance right, don't even embark in your digital money project. So that's certainly top of mind. I mentioned the citizen adoption, the user adoptions, and finally, especially in the emerging market and developing economy, the technology know-how. This is where they need help from development bank and international organization and other central bank, the technology itself.
Awesome. Well, thank you, Hervé. I think this is a great segue into our conversation with Ralph, which is going to be about the security of CBDCs and the systems underlying behind that. So first of all, Ralph, welcome. And what do you think is the future of CBDCs in the broader context of crypto developments?
Yeah, well, thank you, Diana. And first, I must quickly comment on Herv's comment on Steve Jobs, because our company develops CBDC schemes for central banks around the world. So I hope we have enough of Steve Jobs' mindset in our company in order to have the next big thing in central bank digital currency. But when we see the wider context with regard to cryptocurrencies, I think it's only 13 years back that the Bitcoin was established, and now we have around about 6,000 cryptocurrencies around the world. And when I recently in Berlin was visiting the Africa Summit, Europe-Africa Summit in Berlin, I was talking to the delegation of Ghana, and Ghana is actually testing a central bank digital currency. And I was asking what is their rationale, what is driving them? And the main point was that they are fearing that the sovereignty over the own national currency is going away when there are too many cryptocurrency schemes and when large tech companies come with stable coins and really take off the sovereignty of the national currency. And Ghana is not a large country. It is not a country which has a lot of economic strength. So they were really fearing that. The second thing they said is, well, look at Ghana. We are a country which has not really a super wide banking infrastructure. So we must offer something to our people, to our citizens, so that they can participate in the digital world. Because everybody has a mobile phone, but nobody has a bank account almost, right? So they must have things which work in the context of Ghana. And that, of course, makes it important that things not always work online, but also offline function. So there were a few striking arguments for a official central bank digital currency, which the delegation gave me in approximately 1 hour, which was striking. And if you look to China, which was the end of the last panel, I think some of the driving force of the PBOC and the Chinese government to establish a central bank digital currency was also the ubiquity of the big tech giants with mobile payment system to gain back control over the currency and the payment system. So in the wider context, I think CBDCs can play a vital role in the establishment of currencies, the internationalization of currencies, and the stabilization of currency itself.
Excellent. Right. And regarding precisely the security of CBDCs, which was what a lot of people are concerned about, what do you think are the main priorities to get right?
Well, I think, but when you think about the architecture of building such a system, of course, it's not just the algorithms and do the, let's say, digital factory for producing a CBDC, but in the entire distribution system, you have to look ahead what's coming in computing, with cloud computing, with edge computing, with quantum cryptography, with quantum computers. So I think what Herf said in his first statement becomes valid here again. I think the security must be right from the first moment onwards. I think you cannot experiment with that. Typically, currency is a long-lasting system and it should be stable. So security is one of the points, and the resistance to attacks, of course, is a major pillar. But what I mentioned before on the systems design, I think what is important is that you can have different functionalities. I think when you have a CBDC, it should not always be online. It could also be offline. So you must work in situations where offline payments can play a role too. But this is only to mention at least two aspects of the systems design and what you should do first when it comes to security.
Why don't you expand on the importance of offline functionality? Because that can be a key component of CBDCs, especially in emerging markets or in contexts where the level of connectivity is low.
Yeah, and that's the main point, because connectivity is not always the same across the globe. You have countries with very good infrastructures, typically in large cities, but look at large countries or countries in emerging markets, as you mentioned. I think there is not always the possibility, but when you want to have people participating in that, you must provide, when you have a digital currency, also the right hardware wallet so that people can use it in offline situations. Otherwise, it cannot have the equivalent value as it, for example, with banknotes or with physical currency is intact today. And you must match that if, as a central bank, you want to issue such a system so that you can really widely use that.
Yeah, right.
That's the background. It's a very simple background, but it's very powerful when you have situations when you can always use it.
Also in emergency situations, right?
Oh, yes, absolutely. I think of all the terror attacks or of situations where there is floodings. Recently in Germany, we had a big flooding and people, they don't have their mobile phones. I think ATMs don't work. So you must have something which works all the time. What do central banks do when there is a crisis situation? They bring trucks full of money and give it to the people that they not start actually taking things off the shops, so that they can buy something. And that is very important in all the situations. So a digital currency must support that situation.
Exactly. And that's key to propel commerce and commercial activity when access to coins has to be ensured. And that being said, in the end, then how would CBDCs compare with the use of cash anyway?
Well, I think if from the current schemes we actually discussed today, typically what the central banks try to do is to build an equivalent version just in a digital and an electronic format. and they have the same functionality online, offline. You can pay cash, you can pay with your digital wallet, and it mirrors practically. It's a combination. It's complementary, and that's what it's typically all about in most of the discussion we have around the world.
Mm-hmm. Mm-hmm. And also the concept that CBDCs, unlike other cryptocurrencies, would continue to be legal tender, and the liability implications, whether other crypto use cases would not.
Well, if you compare cash, or let's say the normal form or the form we are used to, I think then it's both digital currency and physical cash is legal tender. It's unit of account. And of course, it's a media to pay something for. And that's typically, when you compare that with cryptocurrencies, it's not legal tender, it's not officially backed. It's mostly a cryptocurrency, not a unit of account, because you need typically an official currency to match against, right? And you have key differences here in the system's design and what is really official. So therefore, I think central bank currencies, they have the official backing.
Right. And how finally do you think this would affect trends in the demand for cash?
That's a good question, because I get that all the time, because we also are in the business of producing physical cash next to digital payment schemes and cryptocurrencies. What we saw in COVID-19, the cash demand from central banks was rising by 20%. 20%. It was not going down. I think it's often a myth which comes up, right? It was still rising. Why it was rising? Because people, when they come into situations of insecurity and they don't know where to move, or maybe there's a crisis, they want to have something at hand which represents a value for emergency situations. So it was not practically more demand because of usage and more transactions, but because of hoarding and putting it as a safeguard, so to say, to the side. And we see, of course, in the future, a more stable cash demand and more rise of central bank digital currencies. I think by the end of this decade, we are likely to see a lot of central bank digital currency schemes around the world. And that may lead to a diminishing cash demand for physical cash.
Right. It's on a global scale. And as we see examples popping up across the world in different countries for CBDCs, different economies have different priorities. So the model and the design for the particular CBDC that they would be piloting would entail different priorities. And we have two fantastic examples here. I'm going to start with Canada. Welcome, Francisco. And say, could you tell us a little bit more about the stage of development of Canada's CBDC right now, and what are the priorities?
Thank you, Diana. Thank you for the invitation. And I should start with a traditional disclaimer coming from a central banker. These are my views and not necessarily the ones of the bank. Canada is one of the leading countries in thinking and doing research on CBDCs and fintech in general. But of course, this has been a lot of work. So the Bank of Canada has been doing research on e-money and payments for at least a decade, not only on the research, economic research, but also on the tech experimentation. So many of you might have heard of the Jasper experiments, which we conducted with many participants in Canada. In 2020, Deputy Governor Tim Lane gave a speech in which the announcement was a movement from research and exploration to a state of preparedness, with the recognition that building a CBDC would take years, not only of the technical research, but also the engagement with stakeholders, understanding the trade-offs, and also a further recognition that this is a decision that is, in fact, ultimately outside of the Bank of Canada in the Department of Finance or elected representatives. So this has been a long arc of work in terms of understanding all the issues at play here. And in that speech, several public policy objectives were put forward that gives us the motivation to think of CBDCs. One of the most important one is universal access. The central bank is the only credible actor in the payments ecosystem that can credibly ensure universal access. And this might be even more relevant nowadays with the digitalization of the economy, right? We saw it very much in COVID. In spite of cash holdings are rising, you cannot use cash in online world. So what's the role of a public money in the online world where cash cannot be used? But also the universal access has other aspects. For example, from the point of view of financial inclusion, in a country as big as Canada, the offline use case is very important. Also, hinting at those type of situations when you have a natural disaster or you don't have connectivity, which in the case of Canada, again, it's very much very relevant. So that's one of the key public policy objectives. All other important policy objectives are privacy. So the rise of the digital platforms really bring forward the issue of privacy. And if you didn't think of privacy being a human right, you can think of privacy as a public good. When public, when privacy, the lawful demand for privacy is not provided at the optimal level, consumers can be hurt. And what we mean with that is that with the abundance of data, some digital platforms might be able to use that data to price discriminate, for example, or exclude you, even if you didn't participate in that system. So there's a big component of public good provision in terms of privacy, safety, resilience, competition, and efficiency. And of course, underlying all of this is monetary sovereignty. We wouldn't want to issue a CBDC that destabilizes what has been very well established in Canada, which is stable prices and stable financial system. So this is according to the coalition principles. When the first principle is do no harm, do not break what it's already working well. So this is kind of the landscape in which the Bank of Canada is evaluating different public policy motivations and different design that could achieve the public policy objectives.
That's right. I love what you say with respect to maintaining economic systems the way they work and ensuring basically the security and that everybody is safe and the implementation in the right way, that you're doing the right thing overall. So moving forward to the next question would be, what do you think would be the implications and the challenges in implementing the CBDC in the right way with the priorities that you say?
So yeah, many folks might think that the one of the key challenges is technology, but in my personal point of view, the biggest challenge is in fact getting the trade-offs, the policy trade-offs right. And I will categorize them in three areas. So first is privacy. How much privacy should a CBDC provide? We just heard in the last panel, Chris Giancarlo really pushing to for CBDCs to provide privacy. So surely CBDCs should provide more privacy than private alternatives, but still the question is how much exactly, right? We know that we have constraints in the form of privacy and privacy laws and compliance, anti-money laundering and others that will limit that amount of privacy. But probably the range between more privacy than private alternatives and the limits provided by regulation might be wide. So that's one of the big questions in terms of implementation. Another key one is access. How should we want to provide access to new intermediaries? And what would be the implications of them accessing the financial system, the rails of payments and settlement in a country? So traditionally, you might have a two-tier system, but the technology allows us to potentially have new intermediaries, non-banks, right? If they can appropriately enforce all regulations and comply with all regulations in place. And last, adoption. What's the right level of adoption that is commensurate with the public policy objectives? Should it be just a niche product to, for example, satisfy the offline use case, or should it be widely available and should be like widely used, right? So I think that those were one of the key and tough questions to answer, and there's a lot of international work there.
Yeah, and we're still in progress and getting there on the way. That being said, how would this play a role in the disintermediation of banks, and how would it have an effect on the very intermediated system that we live in today?
Yeah, so that goes back to that question of the implementation and the ecosystem, right? So I think a starting point is to assume that there will be a tier system, right? Central banks, I don't think are willing or even have the DNA today of being direct distributors of CBDCs, right? There's lots of functions, for example, KYC, AML, all those type of functions that are not traditionally in the wheelhouse of central banks. So we will need to partner with the private sector. And of course, banks nowadays are one of the most traditional and actually very efficient custodians, not only of funds, but also of data, right? So the ecosystem should leverage that function, right? Now, what the direction of the ecosystem will take will depend on various conversations. But I think we have to take the strong parts of the ecosystem we have today to push the ecosystem forward.
Right, right. Well, excellent. Thank you so much. And moving to our last but not least speaker, the example of Ukraine. And welcome, Katerina. Could you tell us about the stage of development of the CBDC at the National Bank of Ukraine?
Thank you, Diana. Sure. The National Bank of Ukraine was one of their pioneers who looked into this issue. It was in 2016. And already in 2018, we completed a pilot project that by essence were closer, of course, to the proof of concept. So we issued a retail CBDC called Hryvnia, that is stayed for electronic hryvnia. Hryvnia is our national currency. That was issued on a blockchain platform. During the pilot, we issued a limited amount in the closed environment, available only for the employees of the testing group inside the NBU. We tested the DLT technology. We analyzed potential impact on monetary policy. We studied international experience and even developed interim business model. Though the pilot results were not enough for their general conclusion, and we had even more questions thereafter, and we have to answer them before to take a decision on issuance. So we continue our work on CBDC. We actively engage in with market participants, and it is in progress. Also in 2020, we organized international conference in Kyiv. That was the main idea and goal of this conference was not only to build CBDC club, but also to build awareness among our financial market participants, because this group of people, they are completely unaware what it is CBDC, and it is a mess in the head. What is it crypto and what it is CBDC and what is the difference and how it could be linked. So then we conducted a comprehensive survey among also targeted group of financial market experts with different expertise, just to analyze the potential motivation for usage of CBDC that could be among our population and particular cases that could be popular. And of course, we understand that we cannot lag behind, because recent very quick development that we may see from the statistics, as during the second quarter of this year, rise of so-called decentralized finance or DeFi, mostly stable coins and NFT, equivalent to the volume of tech giant Visa transactions. So the central bank shouldn't lag behind. And we defined three main potential areas where we could continue our study. And we will organize our work in such a way that we will define until the end of the last year a theoretical concept based on which we will perform a pilot project on open environment with the bigger group.
Excellent.
More or less.
Yeah, that makes sense. You seem like there's a timeline for the development of the CBDC, and the experimentations are underway. That being said, what are the Ukraine's priorities for its CBDC model?
Yeah, we defined so far hypothetical three cases that we would like to study further, of course, but as for the moment, we defined three of them. The first one is Hryvnia for retail cashless payments with the possible usage of programmed money, included targeted social payments. The second one is Hryvnia for circulation of virtual assets, and the third one, Hryvnia for cross-border payments. And to comment a little bit on every of this case. The Hryvnia for retail cashless payments with programmability. It will allow to program different type of settlements logic depending on particular circumstances and facts. This could potentially simplify implementation of targeted social payments, reducing their state costs to organize and track all the spendings, like administration and control of these targeted funds and their usage. And on another hand, this could be a very nice and competitive alternative to some types of virtual assets, first of all, like stable coins, due to the similar functionalities that is programmability. So-called like smart contracts, but we understood that not only on the blockchain and not only via smart contract, we could reach this programmability. So it is the main idea for this case to develop such a competitive instrument that will benefit our public and potentially could be actively used. And regarding the second one case is the hryvnia in circulation of virtual assets. It's also a very important case for Ukraine because according to the assessment, we are one of the leading countries according to the usage of virtual assets. And our parliament already passed on the second reading the law on virtual assets. So that's why we also see a big potential in this case. For instance, it could be for exchange. Like we could use our CBDC for an exchange or for an issuance or virtual assets that could be that could serve as a collateral for certain type of operations with the virtual assets. So this case potentially could provide an effective gateway also between their economy and virtual asset market, also including the usage of smart contract. The hryvnia can thus become one of the key elements of the development of this quality infrastructure for the virtual assets in Ukraine, and could be a good supplement for the innovative development of such tendencies as DeFi and programmable instruments. And of course, last but not least, is hryvnia for cross-border payments. Cross-border payments, it's an area that every central bank or almost every central bank who is studying CBDC is looking in. We understood that a lot of implications, first of all, interoperability in terms of technology and regulation and everything, but still being remittances, one of the leading remittances country, Ukraine is also looking in this case because we have lots of potential to make our remittances cheaper, faster and more transparent, and of course more comfortable to the end users.
Excellent. And what would you say about the challenges of implementing the CBDC?
Of course, there are a lot of challenges, and to my mind, first this is coming the security and technology that is quickly moving. Of course, the second one, it should be successful business model, because without successful business model, any case that could be successful. And this business model includes two directions. First of all, it is about the product design. It should be attractive to the end users, and of course, it should be attractive to their market, because we are, as a regulator, we should look into this potential disruption of the second level banking system. We should be aware of this financial stability. That is why it should also include the interest of financial market, not only end users. And it is also the king, I would say, of CBDC, to include all the interest and to combine in one the product successful design. That is very contradictory because lots of features are so different. From one side, a lot of people have preferences for anonymity in this instrument, and on the another side we have issues for financial monitoring that should be complied with. That is why it's really a lot of work to define this successful combination of both features, regulations, and role of their second level banking system, maybe going with a two-tier CBDC or so.
Absolutely. Absolutely. Well, it's wonderful to speak to all of you. Thank you for your fantastic insights. We have a couple of questions from the audience. We don't have time for a lot, but digging into the first one would be, cryptocurrencies became popular because of decentralization. How will CBDCs plan to gain widespread adoption when they won't be decentralized? So essentially, how do we balance decentralization with centralization? And I'll leave it to Hervé, you seem like you have a comment, but feel free, all of you, to comment on this.
Sure. I mean, first thing that comes to mind is that decentralization is a means to an end. It's not the goal in itself. And I would say even for the DeFi world, right? We have to stop thinking as decentralization as a goal, if you will. The goal is resilience, is value for the user, is financial inclusion. Is there are more ways if there are other ways to achieve those goals, so be it. And a sense of centralization adds, for example, trust in the system. So I know the crypto world would argue that you don't need trust if math and a trustless system can accomplish that. The reality, when you talk about money, it's more complicated than the technology. So trust is important and requires a sort of centralizations that is necessary for achieving the same goals.
If I could jump in here, I think thinking about the dichotomy or the discussion between centralized system or a DLT, I think DLT can achieve a lot. In that sense, DLT could be a sufficient platform, but it's not necessary to achieve many of the objectives that central banks themselves have, right? So just kind of piggybacking on Hervé's point there.
Right. And we have one more question really quickly. It's probably going to be for Ralph, but do you anticipate any challenges that clients may face using potentially your platform for the CBDC design for something like Ghana?
Well, I think the implementation, of course, will be country specific. And I think the clear question is, I can't answer that right now because we are still in early phases, because CBDC is still at the early steps, right? And we see in implementations whether there's a problem or not. So it's a good question, but maybe a little early to answer. But I guess we would do everything that is not interfered with.
Right, we are in early stages. And again, thank you so much, everybody. And this has been a wonderful discussion.
Thank you
very much.
Thank you.
Thank you so much to all of our wonderful speakers thus far. Now for our closing conversation, please welcome Jim Cunha, Executive Vice President, Secure Payments and FinTech, Federal Reserve Bank of Boston, and interviewer Stephen Ehrlich, Director of Research, Digital Assets, Forbes.
Hi, Jim. Thanks for joining us. I hope everyone's enjoyed the event so far. Looking forward to this discussion. But before we get into some of the more substantive matters, I think it's important to level set for everybody. And maybe you could briefly just give us an overview of what is the CBDC and sort of talk about how it's different from some of the stable coins that have really been in the press lately.
Sure. Thanks, Stephen. And I really appreciate the invitation. And I'll give the normal disclosure that these are my words, not necessarily those of the Federal Reserve System. So if you look at the three different classes of digital currency, you've got true private digital currencies like Bitcoin, Ethereum, et cetera, or Ether. And those are open to anybody to be miners. Anybody can be a developer. It's open source code. The prices, as you know, fluctuate dramatically. So that is pure private cryptocurrencies. Stable coins were developed specifically to be more stable, as the name implies. So they're usually pegged to the US dollar, and they're usually backed by some type of asset. It could be, and they do vary dramatically. So it could be deposits in a bank, it could be treasuries, or less liquid, but still liquid commercial paper, securities. So it's really just trying to keep a stable value. But it also runs on blockchain. They run on Ethereum, basically. So a CBDC, however, would be issued by a central bank. It would be fiat currency, just like paper currency is. It'd be stable in value. It would be managed by the Federal Reserve itself, but also it's central bank money. So it's actually much like currency or reserves that only banks can hold. It's actually central bank money. So those are the basic differences between the three different types of digital currencies.
All right, thanks. So, I mean, one of the questions that comes up all the time, I mean, even when I'm talking with friends and family about stablecoins and CBDCs, I mean, they'll say, we haven't touched cash in a year and a half. We pay with credit cards, we do direct deposit, ACH, and they'll ask me, isn't money digital already? So what promise, like how will CBDC be better than sort of the electronic payments that we use today?
Yeah, so fundamentally, the difference is that the payments you use today are a liability of a commercial bank. So the money is actually backed by the commercial bank and their solvency and FDIC insurance, et cetera. The key difference is that the CBDC would be a liability of the central bank, like currency itself. So there's a different potential for settlement risk and some other things. Also, those payment systems, by definition, go through banks generally. And if you think about CBDC, based on what the policy goals are, it could be that they can go through non-banks to try to solve some specific problems. For instance, financial inclusion. Most unbanked people work in a cash economy or live in a cash economy. So they could use CBDC as a way of trying to avoid some of the high costs, et cetera, that they have. And one good example is, just take a single mother. She gets a paycheck from her job, no bank account. She goes to check cashier, pays exorbitant fees, buys some money orders because she can't pay the bill directly with cash, or maybe buys a remittance. Those are all very expensive things to do. And I can think of CBDCs with innovation in the private sector that could actually do all those things in a way that could help her save a lot of money and time. So I think those are some of the basic differences.
Okay, no, thanks for that. And I want to kind of get into, in a second, some of the lessons learned and best practices in CBDC design, because I know that you've been working on it very closely at the Boston Fed. But just one more question that immediately comes to mind is, because there's a lot of people listening today that work at commercial banks, where do they fit in, or do they fit in a CBDC world?
Well, those are based on policy decisions, which have not been yet. But I would imagine, these are all my personal views, I would imagine that one distribution channel of how CBDCs get in people's hands is through banks. So right now, cash goes to a bank, then goes to a citizen or a business from the bank. So one model could be that the bank has a wallet, which can allow you to move CBDCs into it, out of your bank account, and vice versa. Like I said, it's a policy decision, but I think that's likely. But I also think that other intermediaries may also exist to move CBDCs, especially for the example I use with financial inclusion. So I do see them being part of it. And the advice I give to them is think about how you innovate. How do you support your customers with a CBDC if you're in the distribution channel?
Okay. So I know you've been very busy conducting research at the Fed and also in conjunction with MIT on CBDC design and implementation best practices. So I'd love it if you could just spend a minute or two and talk about sort of what you've learned throughout this journey.
Well, you said best practices. I think one of the challenges is that there are very few CBDCs in production. China, Bahamas, Eastern Caribbean. So usually best practices come about after long times of being in production and people sharing. So I wouldn't say there's best practices, but I do think there's some approaches that are really important as you approach experimentation like we have. First, I think you should be technology agnostic. Don't presume it's blockchain. Don't presume it's not. Be open. It should be based on policy goals, but many policy goals and decisions haven't been made. So you have to build something flexible. If this is money and it's digital, it's going to be around for a long time. So policies will change, norms will change. So I think a best practice is build it in the way that you can change. Most will likely use cryptography. So what about quantum potentially being a threat in the future? You have to be able to think about the flexibility there. And then you have to think about the use case for your particular country. They have different reasons for doing this. Caribbean, it's really expensive to move cash, but there's a small number of transactions. Obviously, China would be many transactions with other motivations. Sweden has paper currency barely in circulation. So you have to understand the problems you're trying to solve and what are the policy choices that drive how you design it. I also think that writing open source code, as we're doing with MIT, should be a best practice so we all can share and learn from each other's work.
The quantum point is an interesting one. The idea that sort of quantum computers could theoretically break the encryption that's used to safeguard blockchains and frankly, all sorts of internet commerce and communication. So maybe just briefly, I'd love for just a second for you to touch on that problem in particular and sort of talk about how you might be able to anticipate and overcome that.
Well, I think the main thing is to build your platform so that the encryption is not integrated in a way that cannot be easily swapped out and changed to something else. So that's a design architecture consideration. Some blockchains, it's pretty well embedded in the actual code, so it's hard to move to a different cryptography. But I think if we're starting from scratch building a CBDC, we've got to think about flexibility, not just with encryption in this case, but also with how privacy is handled. Privacy norms change, regulations change. So I think it's part of an overall philosophy of being flexible and modular.
So I want to, all this isn't happening in a lab, although it is being developed, I guess, in a research center, but we're in a very interesting macro climate. I know that the US has been patient about developing and rolling out a CBDC. It is the world's reserve currency, and it's more important, I've been told, to get it right than necessarily to be first. But that said, I mean, China is getting close to rolling out the digital yuan. I'd say almost 100 countries at this point are doing some sort of research on CBDCs, and stable coins have really come back into the forefront. I mean, they faced a lot of regulatory pressure from, I mean, Gary Gensler suggested in front of the Senate 2 weeks ago that stablecoins could be deemed securities. So, and other officials have talked about how stablecoins, if they get big enough, could theoretically be a risk to financial stability. So I'd love to hear your perspective on whether or not you think that the timeline to development and implementation has changed or perhaps should change based on this climate.
Well, there's a lot packed into, Stephen. So I guess, so I'll also quote my chair like you did. It's better to get it right than be first. It's not a race. I do think, as I describe it, when you're thinking about payments, every payment system is a system. You know, it's really integrated with a lot of things. And we're really talking about is a system of systems, because there's so much integration, so much interaction between different systems. So I think we have to build it understanding the place of cryptocurrencies, of stable coins, of cross-border considerations. And so I think you have to be aware of all those things. But first and foremost, you've got to build it right for the context of your nation and for the policies that you're trying to satisfy. And they're going to evolve, you know. So I think the macro picture is really important, but it's going to shift, and you can't be tied to what exists today. You have to be flexible enough to tie to what's going to exist tomorrow. And you mentioned stablecoins, and you know, some of that, particularly those are obviously going through some evolution. So each one of those will be changing. So it's a moving target that you have to think about, but not be tied to.
Okay. I mean, do you have any, I know you're not speaking on behalf of your employer, but do you have any personal thoughts on sort of some of the revelations that have come out recently about the collateralization underpinning Tether or USDC or some of the other coins out there?
Yeah, and I'm not even a regulator by job. I'm a technology and payments person. But you know, if you quote your chair and you quote your boss, you know, that's a good thing. So, you know, my boss, the president, Rosengren, and others have said, if you've got a bunch of commercial paper, it's a reserve. If you've got people with a claim on that, and they may get profits from the commercial paper, it kind of looks like a money market mutual fund. Still, obviously, that has to play out. Nobody likes regulatory uncertainty, but it's not a death knell. You know, just because there's uncertainty and regulations evolve or interpretations evolve, you know, I think it's just something that will continue to evolve. I personally think there's use cases for stable coins, well-run ones. Some are better than others as far as how they're managed in the reserves. But I do think there's a position, and I do think there is a definitely use case for coexistence of stable coins and CBDCs. Some have said if you have one, you don't need the other. My personal opinion is this place is for both.
Mm-hmm. Okay. And just going back to the macro climate a little bit, it's been a very interesting time for the Fed. I mean, they just sort of announced a timeline for tapering off some of the bond purchases, and even going back into last year with some of the stimulus payments and sort of like a two-track approach. People that had bank accounts and could accept direct deposit got money right away, whereas others had to wait months and months and months for a check. So I'm interested in how you think, if we did have a CBDC as of perhaps March 2020, how perhaps might that have helped us get money into the hands of especially the unbanked and underbanked faster, and then as we start to sort of taper off and move back into hopefully a more normal economic climate, where might a CBDC fit in there?
So I think CBDC has great promise, but it's not a panacea. It's not going to immediately solve cross-border financial inclusion, because it's a system, like I said, a system within systems. So if you think about it, do we have the address or the information to be able to actually send money via CBDC to someone unbanked? Where does that come from? So we still need to identify who the person is, what they get, make sure that we're eliminating fraud, et cetera. So that's hard. The CBDC itself, I think, can be one piece of solving that problem, but you still have to know who the person is and where you're sending the money. That means if you have an address and a name, how do you translate that into CBDC? So that's the challenge. That's the hard part, that there are components outside of the CBDC that still need to be worked out. And they can be, but you still need an orchestrated process. You need sharing of information generally across, and you need private sector innovation. So I think if those are the public policy goals we set and we build a system with those in mind, I think we can get there. But it's not as a matter of just having one and we solve the problem.
Sure. Okay, just two more quick questions for you. One, China looks to be the first major economy to come to market with a CBDC. Obviously, there are some concerns about it from a privacy point of view and a surveillance standpoint. Like, what are your thoughts on the implications of if China does become the first major economy to come to market with the CBDC?
Yeah. So first, I'll quote once again my chair and the head of the economics at the IMF, who says that just because they have a digital currency doesn't mean they'll take over the status of the U.S. as reserve currency. We're the reserve currency because of our laws, our deep capital markets, our banking infrastructure, regulation, et cetera. You don't rely on a currency because it's the fastest one. So I don't think that's a threat in any immediate term to the dollar. It is a wake-up call, though, for some when a major country like that does build a CBDC, and you have to think about what might be the lower order issues when you think about their own citizens, when you think about cross-border payments, or their roads and bridges program. You know, is there some play there that has some impact in a way? But it's not the reserve currency as a threat. I see it more as, what if 30 nations do it? You know, where is the U.S. in a position relative to those, and is there some impact, or does it just become, you know, a cost of doing business that each nation will eventually get a digital currency, much like we are building a faster payments in the U.S. and many countries already have them. You know, so I think there's dynamics there, but it's not they do it and we have to get it done, you know, today. So.
Okay. And just last thing, a two-part question. One, what are you most excited about when it comes to CBDCs? And two, what is the biggest pain point or problem or challenge that needs to be solved?
All right, so doing reverse order. I think the biggest problem to be solved, and I don't mean this negatively, is we really need to understand and decide on what the policy options are, what the decisions are, what's going to drive, if we build it, how we build it, and what we're trying to accomplish. Because until we have that, we really can't go far enough into building a CBDC. You have to know what you're trying to solve for. And what excites me the most is, so I live in Boston, and if you see in our streets in Boston, we have a saying, don't pave the cow paths, because you get our streets. So I think we have the opportunity to do something different here in CBDC, in how we think about payments, how we think about intermediaries, how we think about who gets to hold the CBDC, how people can innovate. So I'm really excited that we can solve some cow paths. And I think of those as, say, financial inclusion. I think of those as cross-border. So I think those are areas that I'm really excited that we can actually make a difference in the long run if we decide to go forward with this.
Okay, great. Well, Jim, this was fantastic. Thank you for joining us.
Stephen, great seeing you again. Have a great day.
Now to provide closing remarks, please welcome back Michael Del Castillo.
Thank you so much to Steve and Jim for taking us through to the end there, and to all the amazing speakers that shared such inspiring and provocative insights. Also, thanks to the sponsor Celo for helping put this together. I wanted to talk a little bit about some of the big picture takeaways that I took from this event. To do that, I want to go back in time just ever so briefly to the 1970s, actually, when Nobel Prize economist Friedrich Hayek first started writing about what he called the denationalization of money. Now, I think in a lot of ways, Hayek was being quite literal there. He definitely envisioned a world where companies and individuals might someday issue money as valuable as traditional fiat currencies. But I think he was getting at something that's a little more important, that really strikes to the heart of our event today, which is the value of a free market of competing currencies. Up until very, very recently, central bank currencies or fiat currencies didn't have a whole lot of competition. The very nature of geography itself limited the kinds of access that we had to money. and essentially gave central banks sort of monopoly on minting money for a country. However, with the advent of blockchain technology, distributed ledgers, in particular, Bitcoin itself, the first and most prominent application of blockchain, we started seeing some of those borders start to dissolve a little bit. And for the first time in a long time, depending on how you reckon it, for the first time ever, we started seeing this world that Hayek had imagined of a free market of competing currencies. This is a concept that I'm really excited about as associate editor of blockchain and crypto at Forbes, which is well known as, you know, sort of the capitalist tool, as we like to describe it. Because I think that the idea that a free market of competing currencies could lead to improvements is sort of fundamental to the capitalist impulse that drives a lot of the writing. But not everybody likes the borderlessness of blockchain. In fact, I think it's not that difficult to see the fears of that in the reaction that was mentioned so prominently by so many of our speakers to the Libra white paper. The idea that a giant social network could put together a group of companies that agreed to store assets issued by a central bank in a token that could then be spent by anybody in the world sent shockwaves through not only central banks, but through the governments behind central banks. And I think like made this idea of a free market of competing currencies so incredibly visceral. One of the things that I've loved watching as this story has developed and as I've done my small part to help document it, is what it's revealed about ourselves, about our relationship with money. And a lot of people have identified their currency as a core part of patriotism, a core part of national pride. And the idea of a for-profit company coming in and elbowing out a government-backed central bank has been offensive to some people. The idea of a pseudonymous cryptocurrency creator coming in and forcing their central bank to innovate has been offensive to a lot of people. But in this competition, which let's call it what it is, I think is a crucial opportunity that cannot be overlooked for the first time in generations, truly to improve what it means to create money. But more than just how blockchain and distributed ledger technology could improve the actual movement of money, I think it's really important to recognize that what money means to the spenders on a very, very personal level. And it's been really fun to see some of the people in the trenches at some of the countries around the world who are implementing this and doing these first experiments to learn sort of how they strike a balance between innovating with the most cutting edge technology while still staying true to some of the fundamental principles of their nations. With that, I'd like to close this event out by thanking everybody who participated one more time, and remind you all to keep following us. Our Twitter handle is Forbes Crypto, where we're going to be continuing to cover these central banks' progress, as well as much more in the crypto and blockchain space. Thank you so much.
Thank you so much for joining us today. Please be sure to take the post-event survey, which is live now in Slido. We will also email you a link. Later this week, we will also email you a recording of today's event. Thank you again and have a wonderful rest of your day.